Liquidity is one of the most misunderstood concepts in markets. Most people think liquidity disappears during crises. They imagine panic. They imagine sellers overwhelming buyers. They imagine markets drying up. But liquidity does not disappear. It moves, and when it moves, markets break. Liquidity is not cash. It is not volume. It is not activity. Liquidity is the ability to transfer risk without forcing repricing. As long as that transfer is smooth, markets appear stable. Prices move, trades clear, confidence remains. When that transfer becomes constrained, markets do not fail immediately. They hesitate. Spreads widen slightly. Depth thins at the edges. Execution becomes less predictable. Most participants do not notice this phase because prices are still moving. Indexes are still holding. Volatility is still low, but structure is already changing. Liquidity is leaving, not the system, specific locations within it. This distinction matters. Markets do not operate as a single pool. Liquidity is fragmented. It exists in layers, across instruments, across time horizons, across participants. When conditions are favorable, liquidity concentrates where it is needed. When conditions shift, liquidity relocates. It does not ask permission. It does not announce itself. It follows incentives. During stable periods, liquidity flows toward risk, toward yield, toward duration, toward leverage. It provides comfort. It compresses spreads. It suppresses volatility. This creates the appearance of abundance. But this abundance is conditional. Liquidity providers are not obligated to remain. They respond to expected return relative to risk. When that balance shifts, liquidity withdraws from certain areas and reappears elsewhere. The market does not experience this as a smooth transition because pricing assumes continuity, continuity of depth, continuity of access, continuity of behavior. That assumption is fragile. When liquidity moves, the first thing that breaks is confidence in execution. Trades that once cleared easily begin to move prices. Orders that once filled instantly begin to slip. Hedges that once offset risk become imperfect. These are not dramatic events. They are subtle. And that subtlety is dangerous because markets are most fragile when participants still believe liquidity is present. Liquidity does not leave all at once. It thins. It becomes selective. It prefers certain assets, certain maturities, certain counterparties. This selectivity changes behavior. Participants adapt by reducing size, by shortening horizons, by avoiding complexity. This adaptation reduces market depth further. What looks like prudence at the individual level becomes fragility at the system level. This is how liquidity transitions create instability, not through panic, through optimization. Another misconception is that central banks control liquidity. They influence it. They do not command it. Central banks can inject reserves, they can purchase assets, they can signal accommodation, but liquidity is created by willingness to take risk. When risk appetite declines, central bank action becomes less effective. This is why policy responses that worked before now struggle. They add supply, but demand for risk has changed. Liquidity moves away from risk assets toward safety, toward cash equivalents, toward short-term instruments. This movement is rational, but markets are priced as if it will not happen. This is where misalignment begins. When liquidity migrates from one layer to another, correlations change. Assets that once moved independently begin to move together. Diversification weakens. Hedges lose precision. This is not because relationships fundamentally changed. It is because liquidity conditions did. Liquidity determines correlation more than fundamentals. When liquidity is abundant, assets express idiosyncratic behavior. When liquidity is scarce, assets express systemic behavior. Late cycle environments are defined by this shift. Liquidity becomes scarce in risk assets, but abundant in safe assets. Markets still function. Prices still move, but the distribution of liquidity is no longer supportive. This creates asymmetric outcomes. Upside becomes incremental. Downside becomes discontinuous. Participants do not adjust immediately because recent experience suggests stability. This delay is costly. Liquidity migration often begins in places most participants do not watch. Funding markets, collateral haircuts, derivative margins, repo availability. These are not visible on price charts. They are visible in balance sheets. By the time price reflects these changes, structure has already shifted. This is why market stress feels sudden, not because liquidity vanished suddenly, but because recognition lagged movement. Another critical aspect is that liquidity is time sensitive. Liquidity available at one time horizon may not be available at another. Short-term liquidity can be abundant. Long-term liquidity can be scarce. This mismatch creates rollover risk. Positions dependent on continuous funding assume liquidity will remain available. When it does not, adjustment is forced. Forced adjustment is mechanical. It does not wait for sentiment. It does not respond to narrative. It responds to constraint. This is why liquidity-driven moves feel emotionless. They are arithmetic. Liquidity migration also explains why markets often rally before they fall. As liquidity exits risk assets, prices may still rise. Because remaining liquidity becomes concentrated, flows become one-directional. This creates strength, but it is hollow. Strength driven by concentration is fragile. When concentration unwinds, liquidity is insufficient to absorb it. This is how peaks form, not through euphoria, through imbalance. Liquidity migration is also why volatility can remain low even as risk increases. Volatility measures price movement, not structural fragility. Liquidity migration increases fragility while suppressing volatility until it reverses. When volatility finally rises, liquidity has already moved. This creates the impression that volatility caused the instability. It did not. It revealed it. Another reason liquidity migration is misunderstood is because it contradicts intuition. People expect danger to feel dangerous. They expect stress to be loud. They expect warning signs to be obvious. Liquidity migration is quiet. It happens through incentives, through risk models, through funding decisions. No one panics. Everyone optimizes. The system becomes fragile without feeling unstable. This is why late cycle markets feel safe until they are not. Liquidity also migrates geographically. Capital moves across regions in response to policy divergence, rate differentials, currency risk. This creates pockets of abundance and scarcity. Markets experiencing inflows appear strong. Markets experiencing outflows appear weak, but these flows are reversible. When conditions shift, capital moves quickly. This speed amplifies instability. Markets priced for stability assume gradual flow adjustment. Reality delivers acceleration. Another overlooked aspect is that liquidity providers themselves rely on liquidity. Market makers hedge continuously. They require stable funding. They depend on predictable volatility. When volatility rises or funding tightens, their capacity declines. This reduces liquidity exactly when it is needed most. This is not a failure. It is design. Modern liquidity provision is conditional. Markets priced as if it is permanent are mispriced. Liquidity migration also affects narrative confidence. As long as prices hold, narratives persist. As long as narratives persist, positioning remains. This creates inertia. Liquidity moves first. Narratives adjust later. By the time narratives shift, liquidity has already repositioned. This lag creates violent repricing because repositioning happens simultaneously. Understanding liquidity migration reframes market risk. Risk is not the presence of sellers, it is the absence of buyers. Buyers disappear not because they are afraid, but because incentives no longer compensate them. This is the core insight. Liquidity is incentive-driven. When incentives change, liquidity moves. Markets that fail to account for this movement appear stable until adjustment is forced. Late cycle environments are defined by this mismatch. Prices reflect old liquidity conditions. Structure reflects new ones. This gap cannot persist indefinitely. It resolves through repricing, not because something breaks, but because something moves. Liquidity does not disappear. It relocates, and markets must follow. Liquidity migration becomes dangerous when it interacts with funding. Most market participants focus on price liquidity. They watch volume, they watch spreads, they watch volatility. But price liquidity is secondary. Funding liquidity is primary. Funding determines how much risk the system can carry. Price only reflects it after the fact. As long as funding is cheap, abundant, and predictable, markets can absorb shocks. When funding tightens, even slightly, behavior changes. This change is rarely dramatic. It begins at the margins. Haircuts increase, margins rise, tenors shorten, counterparties become selective. None of this appears in headlines. Prices may not move at all, but structure is already adjusting. Funding markets are where liquidity migration starts. Positions that rely on leverage are the most sensitive, not because they are poorly constructed, but because they depend on continuity. Leverage is not dangerous by itself. Discontinuous leverage is. As long as funding rolls smoothly, leverage feels invisible. Returns are stable. Volatility is low. Risk appears manageable. When funding conditions shift, leverage becomes visible. Margins are recalculated. Collateral is revalued. Risk limits tighten. Positions must respond. This response is mechanical. No opinion is required. No fear is necessary. Only arithmetic. This is why funding-driven adjustments feel sudden. They are not discretionary. The system is forced to reduce exposure. Liquidity migrates away from leveraged assets toward unleveraged ones, toward cash, toward short-duration instruments. Markets do not interpret this as liquidity movement. They interpret it as selling pressure, but selling is the symptom. Funding is the cause. Another critical component is collateral. Collateral underpins modern markets. It determines borrowing capacity. It determines leverage. It determines liquidity access. When collateral values rise, liquidity expands. When collateral values fall, liquidity contracts. Late cycle environments often see collateral values inflated. Asset prices are high. Volatility is low. Haircuts are minimal. This creates maximum borrowing capacity. But this capacity is fragile. Small price changes can alter collateral valuations disproportionately, especially when volatility rises. As volatility increases, collateral requirements increase. This reduces borrowing capacity even if prices have not fallen significantly. This is a critical dynamic. Liquidity can contract without large price declines. Markets are not prepared for this. They assume liquidity contraction requires visible stress. It does not. Collateral-based liquidity contraction happens quietly until it forces adjustment. Another overlooked factor is margin symmetry. Margins increase faster than they decrease. When volatility rises, margins are raised immediately. When volatility falls, margins are relaxed slowly. This asymmetry biases the system toward contraction. Liquidity migrates out faster than it returns. Markets price liquidity as if it is symmetric. It is not. This is why recoveries often feel weaker than sell-offs. Liquidity returns cautiously. Risk appetite rebuilds slowly, but liquidity leaves decisively. Another driver of liquidity migration is derivative positioning. Modern markets carry enormous exposure through derivatives, options, futures, swaps. These instruments allow exposure without ownership. They increase efficiency. They also increase sensitivity. Derivative positions require continuous hedging. Hedging requires liquidity. When markets are calm, hedging flows are manageable. When volatility rises, hedging accelerates. This acceleration creates feedback loops. Price moves trigger hedging. Hedging moves prices. Prices trigger more hedging. Liquidity must absorb this loop. When liquidity migrates away, the loop amplifies. This is why options-related moves feel exaggerated. They are not driven by opinion. They are driven by hedging mechanics. Liquidity migration makes these mechanics destabilizing. Another misunderstood area is the role of central bank liquidity. Central banks inject reserves. They expand balance sheets. They lower rates. This creates system-level liquidity. But system-level liquidity does not guarantee market-level liquidity. Liquidity must be intermediated. Banks, dealers, market makers. These intermediaries operate under constraints, capital requirements, risk limits, regulatory pressure. When volatility rises, these constraints bind. Central bank liquidity remains in the system, but it does not reach the market. This is the paradox. Liquidity exists, but it is inaccessible. Markets interpret this as disappearance. It is not. It is misalignment. Central banks can supply liquidity. They cannot force its distribution. Distribution depends on willingness to take risk. When that willingness declines, liquidity pools where it is safest. Cash equivalents, short-term government instruments, overnight facilities. Risk assets are deprived. This is why policy responses that worked before now feel ineffective. They add liquidity where it already exists, not where it is needed. This is not a failure of policy. It is a limitation. Liquidity migration also interacts with time horizons. Short-term liquidity can remain abundant while long-term liquidity evaporates. This creates false confidence. Markets appear liquid intraday, but cannot absorb sustained pressure. Participants mistake activity for depth. They see trades, they see volume, they assume resilience. But depth is about absorption, not activity. Late cycle markets often have high activity and low depth. This is a dangerous combination. Another key factor is concentration of liquidity providers. Modern markets rely on fewer, larger participants, fewer dealers, fewer market makers, more automation. This increases efficiency. It reduces redundancy. When one provider steps back, there are fewer substitutes. Liquidity migration becomes abrupt. There is no buffer. In earlier decades, human discretion slowed adjustment. Dealers negotiated inventories, absorbed imbalance. Today, systems respond instantly. Liquidity is withdrawn at machine speed. Markets priced for gradual adjustment are exposed to this shift. Another structural element is correlation of risk models. Many institutions use similar frameworks: value at risk, stress scenarios, volatility thresholds. When these models trigger, they trigger together. Liquidity migration becomes synchronized. This is not coordination. It is homogeneity. Homogeneity amplifies movement. Late cycle markets are highly homogeneous. Strategies converge. Signals overlap. Responses align. This makes liquidity migration systemic, not isolated. Another driver is the psychology of liquidity providers. Liquidity providers are not neutral. They have risk preferences. They have incentives. When volatility rises, expected return must increase to compensate. If it does not, liquidity withdraws. Markets often assume liquidity is a public good. It is not. It is a service. It has a price. Late cycle markets often underprice this service. They assume liquidity will be provided at past terms. When terms change, adjustment is violent. Liquidity migration also explains why policy surprises are dangerous late in cycles. When markets are robust, surprises are absorbed. When markets are fragile, surprises accelerate migration. A small policy change can trigger funding reassessment. Funding reassessment triggers liquidity relocation. Relocation forces repricing. The magnitude of the move is unrelated to the size of the surprise. It reflects structural sensitivity. This is why late cycle moves feel disproportionate, not because events are large, but because tolerance is low. Another important aspect is the illusion of optionality. Participants believe they can exit positions easily because they have done so recently. This belief is based on past liquidity conditions, not current ones. Liquidity migration invalidates this belief. Exits become crowded. Execution deteriorates. Prices gap. This is when panic narratives appear. But panic is the response, not the cause. Liquidity migration preceded it. Another overlooked element is that liquidity migration is reversible, but not immediately. Once liquidity moves to safety, it waits, it observes, it demands compensation. Risk must be repriced to attract it back. This repricing is often larger than expected. Markets underestimate how much adjustment is required to restore incentives. This is why recoveries often stall. Liquidity is present, but it is not convinced. Another reason liquidity migration is underestimated is that it is not linear. It accelerates. Small changes in funding can trigger large reallocations. Small increases in volatility can cause large liquidity withdrawal. This convexity is structural. Markets priced for linear response are exposed to nonlinear outcomes. Another contributor is regulatory behavior. During stress, regulators prioritize stability of institutions, not markets. Institutions reduce risk, markets lose liquidity. This is rational, but destabilizing. Late cycle markets often assume institutions will support markets. They cannot. Their mandate is survival. Liquidity migration also affects currencies. Capital moves toward perceived safety. Exchange rates adjust. Hedging costs change. This feeds back into funding conditions, especially for global participants. Currency volatility tightens funding. Funding tightens liquidity. Liquidity migration accelerates. These interactions are complex. They are often ignored. Another key insight is that liquidity migration explains why markets often bottom after policy action, but not immediately. Policy action stabilizes funding expectations. Liquidity stops leaving, but it does not return instantly. Markets may continue to fall even after intervention because liquidity is waiting. This confuses observers. They assume policy failed. It did not. It halted migration. Reversal takes time. Understanding this reframes timing. Markets do not respond to policy announcements. They respond to incentive restoration. Another dangerous assumption is that liquidity will return to the same assets. It may not. Liquidity that leaves one sector may return to another. Cycles reshape markets. Assets that benefited from past liquidity may not benefit again. This is why post-crisis leadership often changes. Liquidity migration reshapes winners. Late cycle markets underestimate this rotation. They assume recovery restores the past. It rarely does. Liquidity migration is not random. It follows structure. Understanding where liquidity is moving is more important than predicting price. Price follows liquidity, not the other way around. This is the core principle most participants miss. Markets do not break because people sell. People sell because liquidity has already moved. By the time selling becomes visible, the outcome is constrained. Liquidity. Migration is the silent driver of market adjustment. It is invisible until it is decisive, and by the time it is recognized, positioning has already become fragile. This is why late cycle environments demand structural awareness, not prediction, not narrative, structure. Liquidity does not disappear, it reallocates, and markets must adapt to where it goes. Volatility is not the cause of market instability, it is the consequence. This distinction is critical, and it is widely misunderstood. Most participants treat volatility as an external shock, something that arrives unexpectedly, something that disrupts otherwise stable conditions. In reality, volatility is the system revealing stress that already exists. Markets do not become unstable because volatility rises. Volatility rises because stability has already weakened. Late cycle environments are defined by this inversion. Low volatility does not indicate safety. It indicates compression, compression of risk, compression of liquidity, compression of behavior. When volatility is suppressed for long periods, systems adapt, they optimize, they increase efficiency. This optimization removes slack. Slack is what absorbs shock. Without it, even small disturbances propagate. Volatility is the release mechanism. This is why volatility spikes feel sudden, not because conditions changed abruptly, but because capacity was already exhausted. Another misconception is that volatility creates selling. It does not. Volatility exposes forced selling that was already embedded. Forced selling is mechanical. It is driven by models, by mandates, by constraints. Volatility is simply the signal that those constraints have been activated. When volatility rises, risk models respond. Value at risk limits tighten. Exposure is reduced. Leverage is cut. These actions are not discretionary. They are required. Volatility does not scare participants into selling. It obligates them to. This distinction matters. It explains why reassurance does not stop volatility-driven moves. Confidence does not override constraints. Another important aspect is volatility targeting. Many modern strategies adjust exposure based on realized volatility. When volatility is low, exposure increases. When volatility rises, exposure decreases. This behavior is widespread. Pension funds, risk parity, volatility control strategies. During calm periods, these strategies increase risk. They contribute to stability. They suppress volatility further. This creates a feedback loop. Low volatility encourages more exposure. More exposure suppresses volatility until the system reaches saturation. When volatility finally rises, the loop reverses. Exposure is reduced, selling increases, volatility rises further. This is not panic. It is design. Late cycle markets underestimate how powerful this reversal can be. Because during calm periods, the system appears robust. In reality, it is fragile. Another contributor to volatility spikes is options market structure. Options concentrate risk around specific price levels. Strikes become magnets. Gamma positioning shapes price behavior. When markets are stable, options dampen movement. Dealers hedge in ways that smooth price action. When markets move beyond certain thresholds, this dynamic flips. Hedging becomes procyclical. Dealers must sell as prices fall. They must buy as prices rise. This amplifies movement. Volatility spikes are often driven by these mechanics, not by information, not by sentiment. Liquidity must absorb these hedging flows. When liquidity has migrated away, it cannot. Volatility accelerates. Another structural driver is intraday liquidity illusion. Markets appear liquid during normal hours. Prices update continuously. Trades execute. This creates the impression of resilience, but much of this liquidity is fleeting. It exists only for small size. It vanishes under pressure. Late cycle markets often have shallow depth. Large trades move prices disproportionately. Volatility spikes reveal this shallowness. Participants mistake continuous pricing for deep liquidity. They are not the same. Another important factor is cross-asset volatility transmission. Volatility does not stay contained. It migrates. A spike in one market tightens risk budgets across others. Portfolio-level constraints activate. Participants reduce exposure across assets, not because those assets are directly affected, but because total risk must be reduced. This is how localized stress becomes systemic. Volatility is the transmission mechanism. Another misunderstanding is that volatility is random. It is not. Volatility clusters. It persists. It follows structure. Periods of suppressed volatility are followed by periods of elevated volatility. This is not cyclical. It is mechanical. Suppression builds pressure. Release redistributes it. Late cycle markets often assume mean reversion will contain volatility. They underestimate regime shifts. Volatility regimes do not revert quickly. They change. Once volatility increases meaningfully, it alters behavior. Risk-taking declines. Liquidity provision becomes selective. Positioning shifts. These changes persist. Volatility is not just a statistic. It is a behavioral input. Another contributor to volatility spikes is liquidity fragmentation. Liquidity is not uniform across venues. It is fragmented. Exchanges, dark pools, over-the-counter markets. During stress, fragmentation becomes visible. Liquidity disappears in some venues faster than others. Prices gap. Arbitrage breaks down. Dislocations appear. Volatility reflects this fragmentation. Another overlooked element is that volatility is asymmetric. Upside volatility is welcomed. Downside volatility is feared. But models often treat volatility symmetrically. This creates error. Downside volatility has greater impact on constraints. Margins increase. Collateral. Requirements rise. Funding tightens. The same magnitude move has different consequences depending on direction. Late cycle markets often ignore this asymmetry. They price volatility as if direction does not matter. It does. Another structural factor is the role of expectations. Markets price volatility based on recent experience. If volatility has been low, expectations are low. Low expectations increase sensitivity. When volatility exceeds expectations, reactions are stronger. This creates convexity. Small increases in realized volatility can trigger large reallocations. Late cycle markets are highly convex. Another important insight is that volatility spikes often precede price declines, not because volatility predicts direction, but because volatility reveals fragility. Markets become unstable before they fall. Volatility is the warning. Price is the consequence. But warnings are often ignored because volatility spikes can fade. Markets can recover. Participants learn to dismiss them. This creates complacency. Eventually, a volatility spike does not fade. It persists, and when it does, adjustment accelerates. Another driver of volatility spikes is leverage embedded in passive strategies. Passive funds are not leveraged in the traditional sense, but they create effective leverage through flow sensitivity. When prices rise, inflows occur. When prices fall, outflows follow. This creates momentum. It amplifies volatility. Passive flows respond after price moves. They do not stabilize. Late cycle markets underestimate this behavior. They assume passive capital is sticky. It is conditional. Another contributor is the behavior of corporate actions, buybacks, issuance, hedging. During calm periods, buybacks support prices. During stress, buybacks pause. This removes a stabilizing force. Volatility increases. Issuance may increase as prices fall. This adds supply. These actions are rational. They amplify movement. Another structural issue is the decline of discretionary liquidity. Discretionary participants step in when prices deviate from value. They provide counter-cyclical liquidity. Late-cycle markets have fewer of these participants. Valuation-based investing declines. Systematic strategies dominate. This reduces stabilizing behavior. Volatility spikes fill the gap. Another factor is the impact of volatility on confidence. While volatility does not cause selling directly, it affects perception. High volatility reduces willingness to hold risk. It increases uncertainty. It reduces time horizon. Participants shorten horizons. They focus on survival. This changes market character. Late cycle markets often shift abruptly from long-term to short-term orientation. Volatility is the catalyst. Another overlooked aspect is that volatility affects liquidity pricing. When volatility increases, spreads widen. Execution costs rise. Market impact increases. This discourages trading. Liquidity thins further. Volatility feeds on itself. Another reason volatility spikes are misunderstood is that they are often blamed on news. News provides narrative. It does not explain magnitude. Late cycle volatility spikes often occur on modest news. The reaction is disproportionate. This confuses observers. They search for explanation in headlines. The explanation lies in structure. Another important point is that volatility is path dependent. The order of events matters. A small shock after prolonged calm has more impact than the same shock after recent stress. Late cycle markets are path dependent. They are most sensitive after calm. This explains why timing feels unpredictable. Volatility spikes are not random. They are conditioned. Another structural factor is the feedback between volatility and liquidity migration. Volatility increases funding costs. Funding costs accelerate liquidity migration. Liquidity migration amplifies volatility. This loop is central to late cycle breakdowns. Once activated, it is difficult to stop. Policy intervention can slow it, but not instantly. Understanding this loop explains why markets often overshoot. Another insight is that volatility does not need to be extreme to matter. Moderate increases can trigger constraints, especially when leverage is high. Late cycle markets are sensitive to modest volatility. They do not require crises to destabilize. They require deviation. Another overlooked element is volatility suppression through selling volatility. Many strategies generate returns by selling volatility. They collect premium. They assume stability. This suppresses volatility further. But these strategies must hedge dynamically. When volatility rises, hedging intensifies. This contributes to spikes. Late cycle markets often have significant short vol exposure. This increases fragility. Another important factor is the role of clearinghouses. Clearinghouses manage counterparty risk. They increase margins during volatility. This is prudent. It protects the system. It also accelerates liquidity contraction. Margins rise. Participants must post collateral. Liquidity is drained. Volatility triggers margin calls. Margin calls trigger selling. Selling increases volatility. This is structural. Another reason volatility spikes feel sudden is that markets underestimate tail interactions. Multiple small factors align. Funding tightens. Liquidity migrates. Volatility rises. Hedging accelerates. Individually manageable, collectively destabilizing. Late cycle markets price tails too cheaply. They assume independence. Reality delivers interaction. Another insight is that volatility reveals regime change. Regimes shift from liquidity-driven to constraint-driven, from expansion to contraction. Volatility is the marker. Markets often misinterpret regime shifts as temporary noise. They are not. They change behavior permanently. Another factor is that volatility affects correlation. As volatility rises, correlations increase, diversification fails, risk concentrates. This forces further adjustment. Volatility is both the signal and the amplifier. Another overlooked point is that volatility does not need fear. Fear is psychological. Volatility is mechanical. Systems respond regardless of sentiment. This is why calm participants can still experience violent markets. Understanding volatility requires abandoning emotional explanations. Structure explains behavior. Volatility spikes are not anomalies. They are releases. Releases of pressure built during calm. Late cycle markets are pressurized systems. Volatility is the valve. When it opens, adjustment follows. Not because something broke, but because something reached its limit. Market breakdowns are rarely gradual. They are discontinuous. This is one of the most counterintuitive aspects of late cycle behavior. Participants expect deterioration to unfold slowly, step by step, signal by signal. But markets do not operate that way when structure is fragile. They move from stability to disorder through thresholds. As long as those thresholds are not crossed, conditions appear normal. Once they are crossed, behavior changes abruptly. This is why timing is so difficult. Nothing appears wrong until everything changes. Late cycle systems are non-linear. Small inputs can produce large outputs. Minor disturbances can trigger disproportionate reactions. This is not because participants overreact. It is because constraints activate. Constraints do not ease in gradually. They switch on. Funding limits, risk limits, margin requirements, liquidity thresholds. These are binary. When conditions are met, behavior changes instantly. Another misconception is that markets lose confidence suddenly. Confidence does not vanish. Capacity does. Participants may remain calm. They may remain rational. But when capacity is constrained, they must act. This is why late cycle declines often feel mechanical. Selling occurs without panic, without headlines, without obvious catalysts. Positions are reduced because they must be. Another reason breakdowns are discontinuous is liquidity layering. Liquidity exists at multiple levels: top of book liquidity, depth liquidity, balance sheet liquidity. During calm periods, all layers appear available. During stress, they disappear sequentially. Top of book liquidity vanishes first. Spreads widen. Depth evaporates. Finally, balance sheets retract. Prices gap as layers disappear. Late cycle markets often price assets, assuming all layers will remain. They do not. This is why price movement accelerates suddenly. Another critical factor is that markets are forward-looking. Prices adjust not to current stress, but to anticipated constraints. Once participants realize that constraints will bind, repricing occurs immediately. Waiting is costly. Early adjustment is rewarded. Late adjustment is force. This creates urgency. Urgency accelerates movement. Another contributor to discontinuity is the role of benchmarks. Many participants are measured relative to benchmarks. Underperformance is penalized. This creates herding. As long as benchmarks hold, deviation is punished. Once benchmarks break, deviation becomes necessary. Participants rush to reduce exposure simultaneously. This creates step changes in positioning. Another overlooked factor is the exhaustion of marginal buyers. Late cycle markets are supported by fewer incremental buyers. Valuations are elevated. Risk premiums are compressed. Returns are lower. New buyers require strong justification. Once prices stop rising, marginal demand disappears. Without marginal demand, small selling pressures move prices sharply. This creates discontinuity. Another structural issue is inventory risk. Dealers and intermediaries manage inventory carefully. They are not long-term holders. During calm periods, inventory risk is manageable. During stress, inventory is avoided. Dealers reduce size, they widen spreads, they step back. This removes buffering capacity. Prices move to clear imbalances. Another reason late cycle markets move discontinuously is that adjustment is delayed. Intervention suppresses volatility. Risk accumulates. Signals are ignored. When adjustment finally occurs, it must compensate for delay. This creates overshoot. Overshoot is not irrational. It is compensatory. Markets must move far enough to reset behavior, to reduce leverage, to restore risk pricing. Gradual movement would not achieve this. Another factor is the reflexivity of expectations. Expectations shape behavior. Behavior shapes outcomes. When stability is expected, behavior reinforces stability. When instability is expected, behavior reinforces instability. Once expectations shift, feedback loops accelerate. This shift does not occur gradually, it snaps. Another structural driver is funding rollover. Much of the system relies on continuous refinancing. As long as refinancing is assumed, positions persist. Once refinancing is questioned, positions are reduced. This transition is binary. Either funding is available or it is not. When availability is questioned, adjustment is immediate. Another overlooked element is that markets are optimized for normal conditions. Optimization removes redundancy. Redundancy absorbs shock. Late cycle markets lack redundancy. They operate near capacity. Near capacity systems fail abruptly. This is not unique to markets. It is a property of complex systems. Another contributor is correlation breakdown. During calm periods, correlations are low. During stress, they rise sharply. This is not gradual. Once stress reaches a threshold, correlations converge. Diversification fails suddenly. Portfolios behave as one position. This forces rapid de-risking. Another factor is that markets underestimate tail risk because tails are rarely experienced. Prolonged calm creates false confidence. Risk models extrapolate stability. When tail events occur, models fail simultaneously. This creates synchronization. Synchronization accelerates movement. Another structural issue is regulatory constraint. Regulations are designed to protect institutions. They impose capital requirements. They enforce stress limits. During stress, these constraints tighten automatically. Institutions reduce risk to comply. This removes liquidity. This behavior is simultaneous across institutions. Another reason breakdowns feel sudden is that information arrives continuously, but interpretation lags. Participants see data. They see signals, but they interpret them through existing narratives. Narratives resist change. When narrative finally shifts, adjustment is abrupt. Markets move faster than narratives. Another overlooked factor is that markets do not wait for confirmation. Once a threshold is crossed, waiting is punished. Early movers reduce exposure at better prices. Late movers face worse execution. This creates a race. Races create discontinuity. Another structural driver is convexity. Many positions have convex payoff profiles. Losses accelerate as prices move. This creates nonlinear responses. Small price changes produce large exposure changes. Late cycle markets often contain significant convexity. This amplifies movement. Another factor is that liquidity providers are price takers during stress. They adjust quotes based on risk. They do not anchor prices. This allows prices to move rapidly. Another reason discontinuity is misunderstood is that observers expect symmetry. They expect markets to decline as slowly as they rose. This assumption is false. Upside is supported by liquidity. Downside is constrained by liquidity. The same mechanisms do not apply. Another overlooked aspect is that markets clear through price, not time. Imbalances are resolved by moving price enough to attract opposite flows. When liquidity is thin, price must move further. This creates sharp adjustments. Another structural issue is that late cycle markets often have hidden interconnections. Positions appear independent. They are not. They share funding, they share collateral, they share risk budgets. When one position is stressed, others are affected. This creates cascading effects. Another reason breakdowns feel sudden is that they often occur outside regular hours. Liquidity is thinner, participation is lower, prices gap more easily. This amplifies perception of suddenness. Another factor is that participants underestimate how quickly behavior changes once losses occur. Loss aversion increases sensitivity. Time horizons shorten. Risk tolerance collapses. This change is rapid. Another overlooked element is that late cycle markets have little room for error. Valuations leave no buffer. Liquidity is conditional. Leverage is embedded. Small mistakes matter. When mistakes occur, adjustment is swift. Another structural driver is that markets are adaptive, but not anticipatory. They respond to conditions. They do not prevent them. This creates lag. Lag increases severity. Another reason discontinuity is inevitable is that systems cannot adjust continuously when constrained. They must adjust discretely. Constraints bind, behavior shifts, prices move. This is not chaos. It is structure. Understanding this reframes market breakdowns. They are not failures of psychology. They are consequences of design. Late cycle markets are efficient. Efficiency removes slack. Slack absorbs shock. Without slack, adjustment is abrupt. This is why late cycle environments are dangerous. Not because collapse is guaranteed, but because adjustment is unforgiving. Markets do not decline because something breaks. They decline because limits are reached, and limits do not negotiate. They enforce. One of the most persistent mistakes made in late cycle markets is the attempt to time. Bottoms. This behavior appears rational. It feels disciplined. It is often justified by valuation, history, or confidence in long-term fundamentals. But late cycle environments punish this approach repeatedly, not because the analysis is wrong, but because timing is incompatible with structure. Markets near the end of a cycle do not reward precision. They reward resilience. Bottom fishing assumes that markets behave symmetrically, that declines unfold in a predictable manner. That price reflects value in real time. None of these assumptions hold in fragile systems. In late cycle conditions, price is driven less by value and more by constraint. When constraints dominate, markets do not stop falling because assets become cheap. They stop falling when forced selling is exhausted. This distinction is critical. Valuation is irrelevant to forced behavior. A position is reduced because it must be, not because it is mispriced. This is why markets often overshoot reasonable valuations, not because participants are irrational, but because constraints are binding. Another reason bottom fishing fails is that it assumes liquidity will remain available. In late cycle declines, liquidity is conditional. It appears briefly, then disappears. Price moves faster than execution. Participants who attempt to buy early often find themselves trapped, not because price continues lower immediately, but because liquidity evaporates when they need to adjust. This creates a false sense of opportunity. Temporary stabilization is mistaken for a bottom. Relief rallies are mistaken for resolution. But late cycle markets are prone to false bottoms. These occur when selling pressure pauses, not when structure improves. Without structural repair, declines resume. Another critical error is assuming that being early is equivalent to being right. Markets do not reward early correctness. They punish premature exposure. Being correct about direction does not guarantee survival. Capital is finite. Drawdowns reduce optionality. Margin constraints force liquidation. A correct thesis executed too early becomes wrong in outcome. Late cycle markets amplify this asymmetry. Downside occurs faster than upside recovers. Recovery requires confidence. Confidence requires stability. Stability is absent during adjustment. Another factor that undermines bottom fishing is reflexivity. Buying into weakness can stabilize prices temporarily. But if broader participants are constrained, stabilization fails. Prices fall again. Early buyers become sellers. This adds supply at lower levels. Another structural reason bottom fishing fails is benchmark pressure. Institutional investors face performance evaluation. They cannot endure extended underperformance. Buying early creates tracking error. Tracking error creates pressure. Positions are reduced not because analysis changed, but because tolerance expired. This creates selling at precisely the wrong time. Another mistake is assuming that markets provide clear signals at turning points. They rarely do. Bottoms form amid confusion. Volatility remains elevated. Narratives remain negative. Confidence does not return until after price has moved. This delays participation. Those waiting for confirmation miss early gains. Those entering early absorb drawdowns. This creates a dilemma. Late cycle markets do not provide clean entry points. Another reason bottom fishing fails is leverage sensitivity. Even modest leverage magnifies drawdowns. Margin calls accelerate losses. Forced liquidation removes agency. Late cycle environments are hostile to leverage. They punish even conservative exposure. Another structural issue is that capital preservation becomes dominant. Participants shift priorities from return maximization to survival. In such environments, upside is less attractive than avoiding downside. This suppresses buying interest. Prices do not rebound easily. Another overlooked factor is that bottoms are processes, not moments. They involve time. They involve consolidation. They involve rebuilding confidence. Late cycle participants expect immediacy. They are accustomed to V-shaped recoveries. Those recoveries were policy-driven. They required intervention. When intervention is constrained, recovery is slow. Bottom fishing based on past recoveries fails. Another reason bottom fishing fails is narrative inertia. Negative narratives persist after prices stop falling. Participants remain cautious. Capital waits on the sidelines. This delays recovery. Another structural issue is that late cycle markets often experience multiple waves of selling. Initial decline reflects repricing. Subsequent declines reflect liquidation. Final declines reflect capitulation. Early buyers absorb the first wave. They are vulnerable to the second. Another reason bottom fishing fails is that markets punish conviction during uncertainty. Conviction reduces flexibility. Flexibility is essential. Late cycle markets reward adaptability, not certainty. Another mistake is assuming that bottoms coincide with news. They rarely do. Markets bottom when selling pressure exhausts, not when headlines improve. Waiting for news confirmation leads to late entry. Entering before exhaustion leads to premature exposure. Another factor is that volatility remains elevated after bottoms. This creates whipsaw. Stops are triggered. Positions are exited. This discourages participation. Another structural reason bottom fishing fails is that participants underestimate duration. Late cycle adjustments take time, months, sometimes years. Capital tied up early incurs opportunity cost. This creates pressure to exit. Another overlooked element is that markets reprice risk before repricing growth. Risk repricing dominates early. Growth recovery comes later. Bottom fishing assumes growth will return quickly. This assumption is wrong in constrained environments. Another factor is that markets often require regime change. Old leadership fails. New leadership emerges. This transition is messy. Bottom fishing in old leaders fails. Another reason bottom fishing fails is that correlation remains high. Diversification offers little protection. Losses are broad. Recovery is uneven. Another structural issue is that late cycle markets punish optimism. Optimism increases exposure. Exposure increases vulnerability. Pessimism preserves optionality. Another overlooked factor is that late cycle markets reward patience. Patience allows observation. It allows structure to reveal itself. It preserves capital. Bottom fishing eliminates patience. Another reason bottom fishing fails is that it assumes markets will cooperate. Markets do not exist to validate analysis. They exist to clear imbalances. Another structural driver is that capital enters only when risk becomes tolerable. Risk tolerance recovers slowly. Fear dissipates gradually. This delays buying interest. Another factor is that late cycle markets often experience policy uncertainty. Policy responses are delayed. Their effectiveness is questioned. This reduces confidence in recoveries. Another mistake is assuming that previous lows define future support. Support is contextual. It depends on liquidity. It depends on positioning. Late cycle conditions invalidate historical reference points. Another structural issue is that late cycle markets punish concentration. Bottom fishing often involves concentrated bets. These amplify risk. Another reason bottom fishing fails is that markets reset expectations slowly. Participants must accept new realities. Lower growth, higher volatility, reduced support. This adjustment takes time. Another overlooked factor is that late cycle markets favor gradual accumulation, not aggressive entry, not precise timing. Gradual exposure reduces risk. Bottom fishing concentrates it. Another reason bottom fishing fails is that markets are not obligated to rebound. Stagnation is an outcome. Sideways movement is an outcome. Capital deployed early stagnates. Another structural reason bottom fishing fails is psychological fatigue. Repeated false bottoms exhaust confidence. Participants disengage. This delays recovery. Another factor is that late cycle markets punish overconfidence. Confidence narrows perspective. Late cycle environments require humility. Another overlooked element is that capital flows matter more than opinion. Opinion does not move markets. Flows do. Flows respond to constraints. Until constraints ease, flows remain defensive. Another reason bottom fishing fails is that markets require excess pessimism to turn. Pessimism builds slowly. Optimism fades slowly. Early buyers encounter resistance. Another structural issue is that late cycle markets reward those who wait for confirmation of resilience, not price, resilience. Resilience is visible in liquidity, in volatility behavior, in funding conditions. Bottom fishing ignores these signals. Another factor is that late cycle markets often punish correct macro views, executed at the wrong scale. Scale matters. Small positions allow survival. Large positions force liquidation. Another overlooked element is that late cycle markets favor optionality. Cash is optionality. Flexibility is optionality. Bottom fishing reduces optionality. Another reason bottom fishing fails is that markets are asymmetric. Downside accelerates, upside grinds. Risk reward is unfavorable. Another structural driver is that late cycle markets require time to rebuild trust. Trust is fragile. It cannot be rushed. Bottom fishing attempts to force trust. Markets resist. Understanding this reframes strategy. Late cycle markets are not environments for precision. They are environments for survival. They do not reward bravery. They reward patience. They do not reward conviction. They reward adaptability. They do not reward timing. They reward resilience. Bottoms are recognized in hindsight, not in real time. The desire to act early is human. The cost of acting early is structural. Late cycle markets expose this cost relentlessly. Late cycle markets do not require prediction. They require orientation. Most participants approach markets as forecasting problems. They ask what will happen next. They search for catalysts. They look for signals. This mindset works in expansionary phases. It fails near transitions. Late cycle environments are not about direction. They are about tolerance. Tolerance for volatility. Tolerance for uncertainty. Tolerance for ambiguity. Markets do not break because participants are wrong. They break because participants are positioned for certainty in an uncertain environment. Understanding this changes how behavior is framed. Instead of asking where markets are going, the relevant question becomes, what assumptions are currently embedded? Late cycle markets are defined by narrow assumptions. Assumptions of liquidity, assumptions of intervention, assumptions of stability. These assumptions compress risk. They do not remove it. When assumptions hold, markets appear calm. When assumptions weaken, markets reprice. The shift is rarely announced. It emerges through subtle signals. Liquidity that becomes selective. Volatility that responds faster. Funding that tightens unevenly. These signals do not provide timing. They provide context. Late cycle markets reward those who interpret context correctly. One of the most important contextual shifts is the transition from expansion to constraint. In expansionary phases, errors are absorbed. Liquidity smooths outcomes. Policy provides backstops. In constrained phases, errors propagate. Liquidity discriminates. Policy hesitates. This changes the payoff structure. In expansion, risk-taking is rewarded. In constraint, risk-taking is filtered. The same behavior produces different outcomes. Late cycle markets expose this mismatch. Another defining feature of late cycle environments is path dependency. Outcomes depend not just on direction, but on sequence. Volatility before recovery matters. Liquidity before confidence matters. Funding before valuation matters. This makes linear thinking unreliable. Markets do not move from stress to resolution directly. They oscillate. They test tolerance. They exhaust positioning. They wear down conviction. This is why late cycle adjustments feel psychological, not because markets are emotional, but because participants are. Another key shift is that marginal actors begin to matter more. In stable environments, dominant players set tone. In late cycle environments, marginal liquidity sets price. Small flows move markets. Thin depth amplifies impact. This increases sensitivity. Sensitivity is not instability. It is responsiveness. Responsive systems react quickly to change. This is why late cycle markets feel jumpy. They are not panicked. They are alert. Another critical transition is that policy loses narrative control. In earlier phases, policy communication anchors expectations. In late phases, outcomes override guidance. Markets stop listening to words. They watch constraints. What can no longer be done matters more than what is promised. This alters confidence. Confidence becomes conditional. Conditional confidence is fragile. Another important feature of late cycle markets is that time horizons shorten. Participants reduce commitment duration. They demand faster feedback. This increases turnover. It reduces patience. Reduced patience increases volatility, not because information worsens, but because tolerance shrinks. Another defining trait is that risk becomes endogenous. Risk is no longer external shock-driven. It is generated by positioning and structure. Movements create reactions. Reactions create movements. This feedback loop accelerates adjustment. Late cycle markets amplify their own signals. Another shift is that diversification behaves differently. In expansion, diversification reduces volatility. In constraint, diversification depends on liquidity. Without liquidity, correlations rise. This is not failure of diversification. It is failure of assumptions. Late cycle markets expose this dependency. Another structural change is that narratives lose coherence. Multiple explanations coexist. None dominate. This creates confusion. Confusion reduces conviction. Reduced conviction reduces liquidity. This is self-reinforcing. Another characteristic of late cycle environments is asymmetry. Upside requires coordination. Downside requires constraint. Coordination is slow. Constraint is fast. This skews outcomes. Markets drift upward slowly. They adjust downward quickly. Late cycle markets are defined by this imbalance. Another defining element is that recovery becomes conditional on repair. Repair of balance sheets, repair of funding channels, repair of confidence. Repair takes time. Markets do not wait patiently for repair. They test repeatedly. These tests appear as volatility spikes, not crises, probes. Each probe reveals weakness or resilience. Late cycle markets are diagnostic. They expose fragility gradually. Another important shift is that participants mistake activity for health. Volume increases, prices move, indexes fluctuate. This creates the illusion of engagement. But engagement does not equal resilience. Resilience requires depth. Depth requires diversity. Diversity declines late in cycles. This makes activity misleading. Another key feature is that capital becomes defensive without appearing fearful. Risk is reduced quietly. Exposure is trimmed. Hedges increase subtly. This is not panic. It is adaptation. Late cycle markets are adaptive systems. They adjust behavior before they adjust price. This is why price can remain stable while structure weakens. Another defining trait is that volatility regimes shift abruptly. Suppression lasts until it does not. When it breaks, regimes change. These regime shifts are non-linear. Markets priced for continuity underestimate this. Late cycle markets often experience regime change without obvious catalysts. Another shift is that leadership rotates. Assets that performed well lose momentum. New leadership emerges slowly. This transition is uncomfortable. It confuses participants anchored to past winners. Late cycle markets punish anchoring. Another defining element is that patience becomes asymmetric. Patience is rewarded in risk management. Impatience is punished in positioning. This is counterintuitive. Markets reward action and expansion. They reward restraint and constraint. Another overlooked shift is that optionality becomes valuable. Optionality allows response. Response matters more than prediction. Late cycle markets reward those who can adjust, not those who commit. Another characteristic is that time heals imbalance only when behavior changes. Waiting alone does nothing. Repair requires adjustment. Markets enforce adjustment through volatility. Volatility is not noise, it is process. Late cycle markets communicate through volatility. Suppressing that signal increases fragility. Another important shift is that confidence becomes lagging. Price recovers before confidence. Confidence returns after resilience is proven. This delays participation. This is why recoveries feel unsatisfying initially. Another defining feature is that market memory resets. Participants relearn risk. They rediscover drawdown. This recalibration is necessary. Late cycle markets reintroduce discipline. Another critical element is that outcomes widen, range increases, predictability decreases. Markets priced for narrow outcomes must adjust. This adjustment is destabilizing. Another shift is that stress migrates. It does not disappear. It relocates from equities to credit, from credit to funding, from funding to currency. Late cycle markets transmit stress. Understanding this requires system-level thinking. Another defining trait is that narratives lag structure. By the time narratives change, structure has already shifted. Late cycle markets reward those who observe structure, not headlines. Another important realization is that stability is always temporary. It is a phase, not a state. Late cycle markets remind participants of this reality, not violently at first, quietly. This quiet phase is the most dangerous because it reinforces false confidence. Another defining aspect is that markets do not announce transitions. They reveal them through behavior, through liquidity withdrawal, through volatility response, through funding sensitivity. Late cycle markets are subtle. They punish those waiting for clarity. Another key shift is that survival becomes the hidden objective. Participants may speak about returns, but behavior reveals preservation. This creates mismatch. Markets drift without conviction. This drift precedes adjustment. Another characteristic is that leverage becomes visible only when it matters. Hidden leverage reveals itself under stress. Late cycle markets expose leverage. Another defining element is that fragility accumulates invisibly. Price does not reveal it, structure does. By the time price reflects it, adjustment is advanced. This is why late cycle markets feel sudden. Not because they are sudden, but because recognition lags. Another critical insight is that markets are not moral systems. They do not reward patience for its own sake. They do not punish greed consistently. They respond to constraint. Constraint is the governing force. Late cycle markets are constrained systems. Understanding constraint changes expectations. It removes the need for prediction. It replaces it with awareness, awareness of liquidity, awareness of positioning, awareness of tolerance. This awareness does not eliminate risk. It contextualizes it. Late cycle markets are not broken. They are recalibrating. Recalibration is uncomfortable. It involves repricing. It involves adjustment. But it is necessary. Systems that do not recalibrate fail later. Late cycle markets are forcing recalibration now, quietly, structurally, inevitably. This is not pessimism. It is realism. Realism about how systems behave near limits. Realism about how stability erodes. Realism about how markets adjust when assumptions weaken. Those who understand this do not need to predict outcomes. They recognize conditions. And in late cycle environments, recognizing conditions is the only durable advantage.